Have you seen the price of Bitcoin, gold, and stocks going through the roof? How can you tell if this is a bubble or not? In today's video, I'll explain exactly how. You came here for the truth, so let me unveil that for you. I'm going to look at not the PE ratios and the price to book, price to sales, and the conventional ways that a traditional analyst would look at stocks. You can do that stuff. And I'm not saying that you shouldn't, but in today's video, I'm going to explain the unconventional ways so that we can get an alternate view of that same type of information. Now, when you look at price to earnings ratios, this is important. Of course, you want to analyze a stock, you want to look at the numbers, just like somebody like Warren Buffett would do. They're looking at the balance sheets of all these companies. Numbers are important to some degree, but as he says, you don't want to look at the earnings as in EBITDA or EBITDA. That's the BS kind, he says. You want to look at the numbers in an actual real sense. But I want to look at other things as well. The things that are not going to necessarily show up on the balance sheets, on PE ratios, so that we can get a very balanced view of what's going on. So let me get into it. Here's the first thing. Social media sentiment and hype. Monitoring social media platforms and forums can give insight into investor sentiment and hype around the stock. Excessive hype not supported by fundamentals may indicate overvaluation, as it suggests that the price is being driven more by speculators than the actual underlying financial performance. Let's take, for instance, the extreme example to prove a point. We have all of these dog cryptos, not functional things, not actively, useful things that people are pouring literally billions of dollars into. Remember NFTs? In 2021, these things were hot. This was going crazy, and I was told many times that you would need to own real estate next to Snoop Dogg or you would be falling behind. That digital real estate next to Snoop Dogg is going to be the most valuable thing, and it was going crazy. The prices of these things that are valueless today are, at that time, they were just going up and up and up, and they were trading hands. And people were buying it. And all the celebrities, they were getting into buying these, apes or whatever they're called. And it was pixelated images, JPEGs, but it was limited in quantity. Just because something is limited in quantity doesn't give it a value. It doesn't work like that. It needs to have some level of value to begin with. You can't just say, well, there's only one of these pieces of sand. Here's a piece of sand. There's only one like it. And so you got to pay me a lot of money for it. It doesn't really work that. It has to have some sort of intrinsic value into it. And that's where things started to get real wacky. But of course, you pump cash in like you do in 2020 extreme example, and you will create this madness. So the hype is there. Now that's an extreme example, but it gives us a look at that. Let's break it down a little further. All right. Insider trading activity. Observing the buying and selling activities of a company's insiders can offer some clues about its valuation. If insiders are selling their shares in large amount, it might signal that they believe the stock is overvalued. However, if insider trading, you look at this, right? It needs to be viewed with the lens like, okay, just because insiders are selling, well, they may sell shares for reasons unrelated to the company's performance. And a lot of times, if you look at this, by the way, I have a video that breaks down how to do this, but you can see all of the insider buys and sells. And what you'll see oftentimes is like the CEOs and the higher level people, they get compensated. Like their salary might be okay, let's just say, but then they get compensated if the stock hits certain prices where they get a lot of cash. Like it'll be 10 million there, it'll be 20 million there. Leather Jacket Man from NVIDIA was a recent example of this. And so he was getting 13 million there, 23 million, whatever it was. I covered it on a previous video. And so you see that. You do tend to see that. That's different than somebody just going on saying, okay, hurry up. As the stocks were going up, we saw this in 2020 timeframe. All these stocks that should never have been going up, Peloton, all that, the insiders were selling off because they realized, look, it shouldn't be at this price. Let me just sell off. I'm going to reap the rewards of this bubble. And they did. Okay. And so that's the difference. So I have a video on my channel, something to the effect, if you go to the playlists on my channel, you scroll down, there's one something to the effect of what insiders, find out what insiders like Jeff Bezos are doing with their stocks. Okay, so that's that. And of course, you've seen insiders like Jeff Bezos sell $8 billion in, I think, a matter of 2 weeks, $8 billion worth. So a significant amount. Pairing market capitalization with addressable market. Now, hang on. I don't want to lose you yet. Just look at this. Estimating the total addressable market for a company's products or services and comparing this with the company's market capitalization can provide a sense of overvaluation. If the market cap significantly exceeds the realistic revenue potential from the TAM, the stock might be overvalued. So what I'm saying here is this. Think about how global this company can be. Who do they sell to now? And can they expand to new markets? So you take the example, Warren Buffett's lovely example of Coca-Cola. Now, they're selling in all these different countries. But what if one country decides to open their doors and they say, we want your products because they're a closed country before they couldn't get it. Now suddenly they're, open. Well, that's a new market for them. Other example of this could be in this, with China. You do see closing down in some cases. You see Chinese going after, instead of the iPhone, which the sales have been down quite a bit, they're choosing Huawei. They're doing that for different reasons, but it shows us how big is this market. It's not just, well, the company's really big. Well, they have markets all around the world potentially, and that's a good thing. If they are a digital product, they could be sold globally. If they're a physical product, are there any restrictions on this product? Maybe it's something that just doesn't jive well with that particular country. So keep that in mind. There are also tariffs. These things can affect these companies, and so we should be paying attention to that. Know how global, like obviously if this thing could be bought like a Coca-Cola product, whether it's like that stuff or whether it's water or whatever that they sell, could that be marketed to 8 billion people or at least many billions of people? Yeah, absolutely. Right? There's probably Coca-Cola, whether it's black market or not, in every single country in the world. It wouldn't surprise me. But looking at it, you got to know that some stuff just wouldn't fit. All right. Here we go. Stock price reactions to news. Watching how a stock price reacts to the news can indicate sentiment. Overvalued stocks might show only modest gains or even declines on positive news, suggesting that expectations are already high and positive news is already priced in. We do see this from time to time where stocks are simply pushed to the edge. We were waiting for this. Buy the rumor, sell the news. Keep an eye out for that as well, okay? Because that's something that needs to be understood. Changes in short interest, a significant increase in short interest, that's the total number of shares of stock that have been sold short and not yet covered, might indicate that investors are betting against the stock, believing it to be overvalued. That's not the only reason this is happening, of course. We've seen this before, but that's one possibility. High short interest can signal skepticism about a stock's current valuation. And you can see this for free, by the way. You don't need to pay for that. There are all kinds of websites, like even MarketWatch will give that to you. And you could just type in short interest on stocks into a search engine and you'll get that. It can be very high. Like you'll see extremely high numbers sometimes and it's very fishy. Like what's going on? But that's the case for short interest. And we have market and sector performance comparisons. Comparing a stock's performance with that of its sector or broader market can sometimes reveal overvaluation. If a stock has significantly outperformed its sector or the market without clear justification from fundamentals, it may be overvalued. So when we look at one stock, let's just say we're looking at, it could be car companies, and they're selling roughly about the same amount of cars, and their profit, is approximately the same amount, but one is like way outperforming the other. And you got to look at it like what exactly is making it do that, and is that a justifiable thing, or maybe this is just a little bit of hype. So you got to start comparing, bringing it down, apples to apples, right down to the sector, look within it, and start to compare. Okay, really important to do that. I think it's something that people don't do, and when you're looking at PE ratios and things, it's going to leave that out. You're going to compare it accurately. Historical valuation trends. Analyzing a stock's historical valuation ratios like PE, price to book, price to sales, over time can reveal if its current valuation is out of line with historical norms. A stock trading in the high end of historical valuation might be considered overvalued, especially if there hasn't been a corresponding improvement in fundamentals. So those numbers are important, okay? But you got to take it with everything else. You have to have this holistic view of when you're looking at the stock market. I think it's really important. You don't necessarily want to just sell the media's hyping it, I better jump out necessarily. No, but you can certainly trim a bit off the top. You can certainly hedge your bets, and you don't need to go more into something if, I'm dollar cost averaging, I've been doing that for a year. You don't necessarily need to continue that if you think it's overvalued. Maybe just kind of just wait and see where things go. Always be cautious. Measure twice, cut once. This is a thing that I live by all the time. So these are some unconventional ways. This basically applies to everything. We want to know how much hype is surrounding something. Look at what happened with NFTs, an extreme example. Look at cryptocurrencies where we had these dog coins that were going crazy. And guess what? The same thing is happening now where these dog coins are doing well. I don't want to see that. I want to see strength. I want to see that those billions of dollars that are in whatever, all these silly coins, put them into the Bitcoins of the world. Like that would make it stronger. That would make things better, but instead is diluted amongst all these others out there. The NFTs, there could be some solid fundamental things. Like you could use that to verify. So the company, you buy anything, is it legitimate? Is it verifiable? Oh, it has this certificate. Can you fake the certificate? Yeah, they fake the certificates. Okay. Well, what if I had an NFT associated with that? And then you could verify it. Wow. Okay, great. That's a good, useful thing. Buying digital real estate next to Snoop Dogg. Sorry, Snoop. Not the most useful thing. Okay. So that's what I say. If you have any comments on that, let me know down below. All right. I want to thank you for being here. Hit that thumbs up button on the way out. And if you're interested in the depth of the depth, link in the description. You got to be able to check out the Finance Friday. I know you'll love it. All right. I'll see you on the next one. Take care.